Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out by the chat there by my good friend, Connie Hill. Connie is a 20-plus year veteran of the financial markets and a great educator in her own right. If you have the opportunity to catch one of Connie's webcasts, please do so. I get the opportunity occasionally to fill in on the chat for her. So I'm glad to have her here helping me out as well. She's there to help facilitate the conversation. So keep that conversation going. If you're hearing the recorded version, leave us a comment and let us know what you liked, what you didn't like, or what you thought, or maybe you've got an idea about something. And we will respond to that as quick as we can. And if you're here for the first time, welcome. Thank you for joining us. And if you're coming back, thank you as well. We certainly appreciate all of you doing that. Give us a follow on social media at Ben Watson CS, at Connie Hill on X. You can follow me on LinkedIn. Connie will be soon behind on LinkedIn as well. And give us a follow on our webcast page at Trader Talks Webcasts on YouTube. You can click on that subscribe button down at the bottom of the page. Thanks to our great production staff as well. All right, let's get into what I wanted to talk about. I have seen a couple of different questions coming out in the chat, so I'm going to address those, but I've been wanting to do this for a while. We're going to take our 14-7 days till expiration strategy on the SPX, and I'm going to apply some of the questions and ideas that you have had to a similar strategy. So we're going to do some different things with that. And that'll be, I think, an interesting comparison and contrast. So we're going to go through that in this discussion today. A couple of quick housekeeping items, though, as we get started today. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not advice or any kind of an endorsement. Remember that past performance, no guarantee future results. When we talk about options, whether they're index or equity options, it doesn't matter. Options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks. Standardize options before considering any option transaction. Now, the options that we're going to be looking at, by and large, there may be some exceptions, but by and large are going to be European-style options, which means that as index options, as European-style options, they cannot be exercised until expiration, which means that there is no early assignment risk. However, if you are trading most equity options and some index options that are American style, there is early assignment risk because those can be exercised at any time. Make sure that you know what it is that you're trading before you trade it. Also, if you trade something near expiration, make sure that you understand that there are specific risks, things like lack of liquidity, slippage, wide bid-ask spreads, gamma risk, those types of things where profits can change, turn into losses very quickly. And so there's the possibility that those orders may get rejected or not filled. So just be aware of those risks close to expiration. Also, technical analysis is what we're going to use as part of this discussion. It's not a guarantee of future success out there in the real world, but no form of analysis is. There's no guarantee that the execution of a stop order will be at or near the stop price. And we're going to be using the Thinkorswim desktop software platform here this afternoon, specifically the paper money version. It does not do certain things that a live trading account will do. Fills are oftentimes at a different price than you would receive in a live trading account. So just be aware of that as you move your practice from paper money to live money. There are some differences between the two. Now, what I wanted to do really quickly as we get into this is just talk a bit about index options and the way that we're going to use index options. We've been using them in the context of speculating by going long or short those index options in the combination with things like vertical spreads and iron condors. We've used them as a means to hedge. But what I wanted to do, and this will perhaps answer Chris's question, there are all index options European. The simple answer is no, they are not. Not all are European style. But the next question that follows up is, how do I know? And so I'm just going to show you this really quickly before we pop over to the thinkorswim desktop software platform. Now, the Chicago Board of Options Exchange, Cboe Global, the exchange that provides the majority of the index options and transactions on index options out there, third-party provider of information. They are not a subsidiary of nor connected to Charles Schwab. So any information that you see on their website is their own, but this is a place that you can go to find out more about index options and some of the characteristics of those index options, some of the contract specifications, those types of things. You can go to the Cboe. You can find out. The page that I happen to be on here is Cboe.com, CBOE.com, then tradable products, then SP500, XSP. I'm going to talk about XSP today, which is why I wanted to bring you here. But this can give you some information about index options in general, first of all, and about some of these specific index options in particular, like the XSP. You're going to see some of the characteristics potentially, and we're not tax advisors. We don't give tax advice. I can direct you to some resources for tax advice via the Schwab branches. However, index options may provide, depending on the account, depending on the type of the option, potentially 60/40 tax treatment preferential to perhaps regular equity options. So that's one thing to consider. Also, the fact that index volume has been picking up significantly on the XSP, which is the smaller S&P 500 index, if you will. That volume has been picking up. This is as of today, average trade volume 128,419 contracts being traded. If we go back out a little bit, you'll see some information about kind of the market as a whole. SPX options, quite a bit more transactional volume going on in SPX options, 4.27 million traded today. VIX, about 742,000 traded today, which is quite a bit more than the futures market, to be fair. And across the board, as far as options transactions today, 53.77 million option transactions taking place today. So becoming a very liquid market. Index options also becoming a very liquid market as well. So that gives you a little bit of understanding of where you can go for more information about index options. Go to Cboe Global, CBOE.com is going to give you some more information. So let's pop over here to the thinkorswim desktop software platform. Again, remember, we're using the paper money version of the platform. And as we get in here, let's take a look at what's going on with the index. And then I wanted to answer the question earlier, which was, hey, earlier this morning, JDLMI said this morning after the market opened, the VIX started rising, the market was still okay, and then the market started to go down. Is the VIX early? So we'll talk about that here in this context. So let's see what's going on, first of all, with the SPX, with the S&P 500, kind of the broad cross-section of the market. RSI is kind of flat. The market is kind of flat today as it was yesterday. A little bit of a downward movement towards that 50-period moving average. It bounced back up, but really not a lot of movement today. Up, or actually just down in this particular case, 0.10, 0.09 now at this point, kind of toggling back and forth, but not a lot of movement here. Boy, I love that question, MDC. How will 24/5 affect index trading? And I think what you'll see is that because there's already in some cases extended hours in terms of some of these option contracts, 24/5 trading for indexes will, I think, help to align it more closely with the futures market. So I think there is perhaps a possibility of greater liquidity because of that 24/5 trading characteristic, or what will eventually become 24/5 trading. I think it will allow for hedging of risk using index products, which will make them more potentially desirable as a hedging product, because there is the ability to hedge those and create those transactions in the after hours when news sometimes happens, because news doesn't just happen between 9:30 and 4 p.m. Eastern time. So that's kind of what we're seeing here on the SPX, kind of bouncing up off of that RSI kind of flat. NDX, the NASDAQ, again, kind of similar scenario to yesterday, bouncing its head against that 50-period moving average, staying below that 50-period moving average in this case. The RSI kind of ticking back up a little bit here. So NASDAQ, the technology-heavy NASDAQ, may be giving us a lower high in this particular case. If we look at it in the context of the previous high back about 2 weeks ago, rallied up, pulled back, has now rallied up. And if it stops here, now makes a new lower low, and continues to close down, that could be a lower high. And we could see a slight short-term trend change. Now, the Russell 2000, on the other hand, definitely if we get this close, in this particular case today, if it closes where it is, I think that now becomes potentially a new lower high relative to this previous high, because we're starting to see that move lower. Now, it doesn't become a new lower high, I think, really realistically, until we get another closing candle lower, but we can debate the merits of highs and lows a lot here. Nevertheless, we're seeing a little bit of downward movement in the Russell 2000 today, in fact, down 0.40%, and the RSI kind of ticking a little bit lower. So I want to go back to the question that was asked about the VIX. So I want to pop over to the VIX really quickly. So in light of that, let's do this. I'm going to grab my VIX grid, and this is a grid that I just use when I'm teaching something like one of our market drive events, or when I'm teaching our market and sector analysis webcast that Michael Fairborn teaches. Sometimes I will sit in for Michael. But here's the VIX. And remember, the VIX index is simply a measure of the pricing across the board, in the money, at the money, out of the money, on a 30-day average of SPX options. So the VIX is nothing more than reflection of the pricing, the implied volatility, if you will, of SPX options. So does the VIX move first? Does the SPX move first? Which comes first, the chicken or the egg here? So I've got on here a comparison. So the purple line is the SPX, the VIX are the candlesticks here, and I'm just going to zoom in so that we can kind of see this relationship. Normally, when the market moves down, the VIX moves up, and when the market moves up, the VIX moves down. Doesn't always happen that way. And in fact, that skew of market down, VIX up, market down, that kind of thing, that skew has changed a little bit, especially, well, not so much in the last little bit, but over the course of this last holiday season, we saw this, where there was a lot of speculative pressure, not just to the downside to hedge, but also speculative pressure on major components of the SPX to move up. Because remember, buying, whether we're buying puts or whether we're buying calls, buying of options, buying pressure on options increases option prices. So if option prices are going up, the VIX is going up. If SPX option prices are going up, the VIX is going up. And if SPX option prices are going down, the VIX is going down. Now, to be fair, the way that the VIX is normally used is in that kind of inverse relationship, in that, you know, option traders, institutional option traders largely, now becoming more retail option traders, use the VIX as use the SPX as a means to hedge long stock portfolios, meaning they'll buy SPX put options to offset downside risk in long stock portfolios. When they're buying because they have to provide that protection and manage their risk, and therefore they're willing to pay whatever for those options. If they're willing to pay whatever for those options, market makers are going to reflect that in raising the prices of those options, and therefore the VIX is going to rise. So normally, if you want to think about what drives the relationship, it's going to be the SPX option prices, not the index itself, but SPX option prices beginning to rise. That's going to drive the VIX. So this is where it gets a little complex, right? Because SPX options are not the SPX. What investors, what traders are willing to pay for SPX options is reflective partially of what the SPX is doing, but secondarily to what their expectations that the SPX are going to do. So this is where we get into some of this challenge, right? Because if we were to look at what's going on with the VIX, now what I'm going to do is I'm going to drop this back down to, I'm going to change my time frame here to a 1 day, 1 minute time frame. So we're going to see the VIX candles change. These are going to be 1 minute candles. So you saw what happened here. And we still had the SPX. So now that comparison line is going to be a 1 minute comparison to the SPX. The VIX started rising before the SPX started to fall, the index itself. Why? Because there was anticipation of something on the part of institutional traders. Those institutional traders were thinking perhaps maybe the jobs report, the jobs numbers that were coming out, or earnings announcements were going to create some downward movement in the price of the SPX index. So what did they do to hedge their long stock portfolios? They bought SPX puts. When they bought SPX puts, what did that do to the VIX? That drove the VIX higher. So, but remember, this is still a 30-day or a 30 period average. That's what the VIX is. So there's going to be some lag. So seeing this information, knowing that the VIX was rising and the market was moving down, that's the normal relationship. That's, I think, and to JDML, your point, don't read too much into that. That's kind of that normal relationship that the VIX starts to move because the options are starting to move. It does not necessarily guarantee that the SPX is going to change direction or going to move down or move up. It reflects the fact that institutions are worried primarily that the SPX is going to go down. Doesn't mean that it will. So it's kind of gone down. We can kind of see those coming back together. And when those get too disparate apart from one another, you typically tend to see that relationship be arbitraged, because then institutional traders can buy VIX options and sell SPX options, or sell SPX or buy SPX options and sell VIX options, and they can arbitrage that volatility relationship. So what I'm going to do is I'm going to take this back out here a little bit. We'll go back to our 1 year daily chart. And the other view that I have on here, let me grab these really quickly, is the VIX and the VVIX, the volatility of the VIX. So the blue line is the VIX itself. The VVIX is the volatility. In fact, it's the implied volatility of the VIX, if you want to think about it that way. So VVIX and VIX, when those two get separate from one another, when you start to see the VVIX leading what the VIX is doing, it's very likely that you're going to see a move in the VIX itself. Now, on the other side of that coin, this can also be an indication of some complacency. When the VIX is low and the VVIX moves below, we've seen it a couple of times. Here it is back here. We can see it back here in June. We certainly saw it back here in the March into April timeframe, where VVIX had crossed down below the VIX, meaning the volatility of the VIX was lower than the VIX itself. That relationship often indicates complacency in the market, that institutional investors are not buying protection. They're not willing to pay more for protection, and therefore sometimes price can move, and then they're forced to buy in a panic, which means that you often get a spike in the VIX following a drop in the VVIX below the VIX. It's not always, not 100% correlation, but it can be an indication. Yeah. It does, Mark, to your point, it does pretty much synchronize with changes in the extrinsic value of SPX options. Yes, because that's what it's driven by. Those option prices drive the VIX. That's what the VIX index is. So good insight there. Absolutely. Yeah, for sure. So now that we know that, well, how do we use this? Well, we can trade the VIX. We've got a short vertical spread on the VIX at the moment. We can use that characteristic. We know that the VIX tends to be mean reverting, and it tends to be mean reverting very quickly. And this is the other reason why. This is the other reason why the VIX tends to spike quickly and then bleed off very quickly, is because that presents an arbitrage relationship between the options and the VIX index itself, or the VIX options, or even the VIX futures. So that's one way. Now, by the way, I mentioned futures as a tradable instrument. If you're going to trade futures, make sure that you understand the fact that futures are a highly leveraged product. They're not suitable for everybody. They are also a product that requires separate trading authorization. So be aware of that. Yeah. Yeah, Roger says, I just got an aneurysm. The implied volatility. Yeah, exactly right. Wait till we get to like to some other implications of the VIX and some of the other orders of the VIX. How did I create this VIX chart? It's simply a VIX with a comparison line, a shared comparison of the VVIX. I'll share this with you guys. So let's do this. Let's go right here. I'm going to share this grid. It's not a guarantee of accuracy or time, just like anything that we share, but it is a helpful tool. So there it is right there. It's also not a recommendation or any kind of advice. It is simply for illustrative and educational purposes only. So there's our VVIX chart. We see where the VIX is relative to the VVIX. Symbol for the VVIX is just VVIX. VVIX. So let's do this. I want to come back over here to our monitor tab. I want to take a look at our 14.7 strategy really quickly and just see how this is working for us in this particular case, and see what we can do with this. So the strategy, for those of you that are brand new, this particular strategy is one that we've been doing for almost 2 years now. Every week on Wednesdays, we've been selling a vertical spread on the SPX, and we've been buying it back 7 days later. So selling it at 14 days to go until expiration, buying it back at 7 days to go until expiration. So here we are. We sold last week at the 66.60 put option. We bought the 66.40 put option, short put vertical spread. We sold it for $2.40 to open the transaction. It's now currently trading at 55 cents. So it's done what we've expected it to do, even though the volatility, or the SPX, has come down a little bit and has come down a little bit today. The other thing that's happened is that implied volatility has worked in our favor, and time decay, most importantly, has worked in our favor as well. This is primarily a time gathering strategy. We're capitalizing on rapid time decay on an out of the money option in the beginning part of its lifespan from when the time we put the trade on. So what I'm going to do is I'm going to right click, and we're going to create a closing order, and I'm just going to buy this back. Now, here's the thing about this strategy, and you know that we've talked about this before if you've been here before. The reason I do this strategy the way that I do this strategy, 14 days to go until expiration, 7 days to go until expiration, and the way that I put this strategy on is to maintain consistency. And we'll buy that back at 7 days, come what may. We don't take it off if it drops quickly. We don't take it off beyond the 7 days. We buy it back at 7 days, come what may, whether it's a winner or a loser. We don't adjust, we don't put a stop on it. That's to establish that consistency of this strategy. So we're just going to go ahead, click on confirm and send, and fire this off. And we're going to make sure it's coming off here. We're going to put it on, make sure that that's a close order. And we're going to collect. We brought in originally $2.40. We're going to pay out 55 cents to buy this back. So we're capturing the fair majority of the gain that we're making we're potentially going to make in the trade. But one notion I will disabuse you of right now, very likely we are ever going to get, very unlikely that we are ever going to get max theoretical gain out of this trade. What does the slippage look like? Well, Mary, this is one of the most liquid traded products out there. So not a lot of slippage. even at the far out of the money position. We'll take a look at that as we get into this discussion. So the first thing I want to do is I want to take you through this process. So I just call it, Octavio, I just call this my 14-7 strategy. So what I'm going to do is I'm going to take us through the process of initiating a new one, and then I'm going to start the new idea. So we're going to go over here to the chart. I'm going to bring up my option grid, which is my, let's go right here, index options grid. For those of you that are brand new, I'm going to share this as well. I'm going to share this grid. Again, same considerations apply for this shared item as they did for the other one. Not guaranteed as to time or accuracy, but there is my index options trading grid. Left-hand side is a 1-year daily chart. Right-hand side is a 3-month daily chart. Left-hand side has a 200-period moving average and the MACD. Right-hand side has a 3-month daily chart, probability of expiring cone, and the implied volatility indicator down on the lower panel. So what I'm going to do, I'm going to go back to the trade tab and just double check and see where our 14 days to go until expiration date is. It's the 25th of February. So I'm going to go back to the chart and I'm going to move this vertical line that I've got here, which I put in place by using this time level on the drawing tools. I'm just going to right click and I'm going to activate this, and we're going to take this out to the 25th. And the reason that I'm putting this out at the 25th is that is where my next strategy is going to be used, is going to be put on. That's where my next expiration date starts, is on the 25th, because that's 14 days to go from expiration. Then I've got that probability of expiring cone, and the probability of expiring cone is very simply, I'll just show you right here, probability of expiring cone is very simply a view of one standard deviation move from where the price of the stock is. Okay, one standard deviation move. So now what I'm going to do is I'm going to take my line tool and I'm just going to simply draw where that crossover is, and it's at the 67.20. I'm not being too particular, not too precise. I'm going to go to the 67.20 level. And you notice I leave those hash marks in every single time, so you can kind of see what's happened. As implied volatility has risen, they've widened out. As the index has kind of rolled a little bit and gone sideways, they've kind of stayed in the same area. You can see where that, I'm not JB Zinc. This is Ben Watson. I won't be offended at that, but you know, fair enough. But that's where our level is, 67.20. So here's what I'm going to do, is I'm going to come back to, and Pico asked the question, why the 200-period moving average? It's trend director. So when the SPX is above the 200-period moving average, we're selling put spreads. When it's below the 200-period moving average, we're selling call spreads. Okay. So we're going to go here to the 67.20. I'm going to go to the trade tab. We're going to go out to the 25th of February expiration, 14 days from now. And we're going to go out. I've got to probably put in here 150 strikes, one up or down. I got you, Zinc. You're good. No worries. No worries at all. All right. So we're going to go with the 67.20. I probably have, is that it? 67.20? Let's just see. 67.20. Yeah, I probably have too many strikes now. So let's go maybe 120 strikes so that we're not going way out there. There it is, 67.20. And you notice I'll change my layout from intrinsic and extrinsic, because I was teaching getting started with options webcast earlier. So here's 67.20. It's got about a 16-cent delta. So more often than not, this is going to fall right around the 15 or 16-cent delta, right at that one standard deviation move. I'm going to sell the 67.20, and I'm going to buy the 6,700. We're going to make this 20 wide. That has been what we've been doing, is making this a 20 wide short vertical spread. Oh, okay. Interesting. Huh. All right. Are you, James? Wow, James. Sitting in on my webcast, James. That's cool. All right. I like that. Okay. So 67.20, 6,700. That's our $20 wide vertical spread. It's bouncing back and forth. And again, you talk about slippage. These have about 10 cents wide in between these prices, but they're also pretty active. So we're going to try to work this a little bit. We're going to see if we can get that 220. I'm going to lock that in somewhere around that see if we can get 220 for this and kind of work that inside and lock that in place. We're going to click on confirm and send. We're going to make sure that that's what we want it to do to open the transaction. We're going to bring in 220 bucks, max theoretical loss. If this moves big, and if it does, we could potentially take a maximum theoretical loss, because remember, we're going to buy this back at 7 days, come what may. Probably not going to take the max theoretical loss. We may take some loss in this trade. So I'm going to put this back down here in our index options weekly group. I'm going to go ahead and click on send, and we'll fire that order off. We'll wait for that to kind of settle. We might have to bump that a little bit, but this is moving around a little bit, so we may be able to get that inside that bid-ask spread just a little bit. It's paper money, so it normally will fill at the midpoint. So if that mid comes to that level at $2.20, we may, there it goes, boom, we got it for 220. So sometimes it pays to work that order a little bit. Now that's the strategy. And the idea is we're going to come back over here, 14 days to go. We're going to wait for this to theoretically get cheaper before we buy it back 7 days from now, and then turn around and sell another one. Okay, great. Now that's the box stock, out of the box 14.7 strategy. Here's what I want to do now. I'm going to come over here, and the reason I brought up the XSP earlier is I'm going to go to the XSP, which is also European style. It is basically a tenth of the big index, okay? And it is a little bit less liquid, if you will, than the SPX. Because remember, the SPX was trading about 40 some odd million contracts today, and this is trading about 124,000 contracts for the day. So, you know, I mean, there's a difference in terms of the liquidity, but the movement is the same. So I want to kind of use this as a means to do this. So what we're going to do, I'm going to change the tool a little bit, because some of you have asked the question, well, why don't I use a faster moving average? So we can do that. I'm going to grab my moving average, and I'm going to put on here another moving average. I've got a 200 period on here. I'm just going to do this. SIMP, simple moving average. You can use whatever you want. You can use an exponential, doesn't matter, nothing different there. And I'm going to be more reflective because of current price movement. So I'm going to go to, we'll go from a 200 down to a 50 period moving average and use that as our delineator. If price is above the 50, then we're going to sell put spreads. If price is below the 50, we're going to sell call spreads. And we'll use that 50 period moving average. I'm just going to change this a little bit. I'm going to make this, since my other one is blue, I'm going to make this kind of a more urgent color. I'm going to make that orange. 50 period moving average, click on OK, apply, and OK. So now I've got that 50 period moving average. So I'm going to hide the 200 at this point on this side of the grid. Click on apply and OK. So now, where is price relative to the 50 period moving average? It's still above. So that means I'm going to be selling put spreads. But we're going to still keep with this one standard deviation time frame or range over here on the right-hand side. And I'm going to go to the trade tab for XSP, and I'm going to go out to 14 days to go until expiration. And that's the 25 Feb expiration. That's right there, 25 February. Okay. So Ken asked the question, when does one use a simple moving average and not an exponential? You can use it either way. They're relatively interchangeable, and there's not a huge difference between one or the other. We've got some great webcasts. I'll ask Connie to go out there and grab one. I taught one just probably 2 or 3 months ago, comparing moving averages to see which one is better, or not necessarily better or worse, but which one is perhaps more desirable in certain circumstances. Exponential versus SMA. I also compared the whole moving average to that as well. Guess which one won? Simple moving average. Anyway, that being said, we're going to pop back over here to the chart. We're going to say, all right, 25 Feb, we're going to use that one standard deviation. I'm going to grab my line tool here. We're going to find 25 February. That's right here. I'm going to drop that vertical line so that we can see where that is. Okay. And yes, you can create an alert about that, Zinc. Yeah, Mike Fairborn just did that, I think, a few weeks ago in his ThinkScript class. All right, let's do this. Let's grab this line right here, the line tool. We're going to do the crossover right here, 672. Well, that makes sense because the cross on the big index was 6720. So 672, in this case, is where that crossover occurs. So now what we're going to do is we're going to come back over here. Now, we could use that. Now, I'm going to use that as a measure, but I'm also going to talk about some of the other possibilities here. So we're going to go here to the 25 Feb expiration. So the 672 strike price is what we're going to look at. 672, $2.05 by 218 ask. So fairly narrow bid ask spreads here. There's probably some pretty good liquidity. That's about the 16-cent delta. And if we were to create this, we might go 2 points wide to the 67.20. We could go even wider. So the first one I'm going to create here is I'm going to go even wider. I'm going to go to the 672. And we're going to create the 672, and then I'm going to go out to the 662. Let's go, in this case, that's going to be, what is that, 10 points wide on the small index, which would equate to 100 points wide on the big index. So I'm going to go out to that one right there, to the 662. We're going to go 672 by the 662. And we're going to get $86 86 cents of credit against basically a $10 wide vertical spread. Now, the problem is that's not a lot of credit, but it's roughly equivalent to what we were getting on the other one, maybe a little bit larger credit, but we're bringing in $84 against $916 of theoretical risk. But think about the probability here. This has a 16% probability of being in the money at expiration, at least the short strike does, which means that it's got about, what, an 84% probability of being out of the money at expiration? So the other idea that some traders might have, and we're going to go ahead, I'm going to put this one on so that we can see this. So I'm going to go here to our Index Options Weekly group, and we're going to put this order on, and I'm going to fire that one off. We'll see if that fills. We'll see if we get that. Now, one of the other questions that people have had is, why don't we just go, since we're pretty confident about the probability and we're okay, that just sold for 85 cents. So that's now in our section there. So what if we were to just create a vertical spread at the 10 delta? We just sold the vertical spread at the 10 delta every time. So we're going to try that. I'm going to put this one in there as well. So the first one was kind of replicating what we were doing on the 14.7 on the SPX, just a wider vertical spread. Now what I want to do is I'm going to come to I'm going to go to the 10 delta. I'm not going to do an equivalent, the same strike price, because I don't want to create an embedded, I don't want to cut off that vertical spread that I have already. So I don't want to have an embedded vertical there. But I'm going to go to the 663. We'll come in, it's still 10 delta. And we're going to create a 10 delta short strike. And I'm going to go 663. And we could go really wide, or we could go really narrow. I'm going to go fairly wide here. I'm going to go 10 wide. So we're going to go 663 to 653. I'm going to buy the 653. So we're creating, and you can see the credit that we're getting there, 10 wide, 50 cents credit. And if I click on confirm and send, 51 cents against 949, smaller range, but our max loss is pretty big. But now this is a 10% probability, which means it's got about a 90% probability of being out of the money at expiration, higher probability, but we're bringing in less credit, right? We're bringing in less credit. Now, Valen asks a question, wait a second, could we sell the call spread too? We could. Yeah, we could sell the call spread. We'll do that in another strategy session, another webcast. I just want to get this one involved and going too. So I'm going to put this in our weekly options section, since we're doing these weekly, 14.7. And I'm going to do something else here with these. We'll see if that one fills. So the other change that I'm going to make to this really quickly, we're going to go back to our monitor tab. That one hasn't filled yet. We're just waiting for it on the XSP. We've got those two. We might put a note in here that says, all right, we know that this option, that this vertical spread, this one is um, our 16 delta, this one's our 10 delta. What I'm going to do is I'm going to take this one. I'm going to take that 16 delta, the kind of replicating one. I'm going to do this. I'm going to right click and I'm going to create a closing order. So I want to buy this back when it's given me about 80% of that max theoretical gain, regardless. So we're going to take 82 cents. So we're going to take 82 cents minus, in this case, 80%. And so if this trades at 16 cents or less, we're going to look at buying it back. So I'm going to create this as a closing order. And I'm going to say, fine, let's make this a limit. Buy it back for 16 cents or better. Make that good till canceled. And we'll see if we get hit on that and it gets filled before we get to that 7 days to go until expiration. So I'm going to go ahead. This is our closing order. That's going to be a waiting order out there, or working order. We're going to go back to our monitor tab, and that's got an order to close it down. If, now we haven't filled this one yet, we'll look at that one, but that's going to look at taking that trade off if it's done the majority of the work before it gets to 7 days to go until expiration. So we've made a couple of significant changes here. We've changed the moving average. We've changed the index that we're using, although the movement is the same, and we've changed the way that we're exiting. So I want to do that so that we can establish this, so that we can compare and contrast the out-of-the-box 14-7 strategy with this 14-7 strategy. If you want to learn a little bit more about these ideas, come on over here to the Trader Talks webcast page. And in the Trader Talks webcast page, you can type in index options, and you can get the entire playlist of the index options webcast series. There's Connie teaching layering into index options. She's taught this webcast a number of times for me. This is one that's really cool, how zero DTE index options play out hour by hour. That's a phenomenal webcast if you haven't had the opportunity to watch that one. Connie did a great job with that. Click on subscribe if you haven't done so already. We'd love to have you there. By the way, we're going to be in San Diego in 2 weeks doing a market drive event. Come and join us. There's still room, but we would love to have you registered. It's going to fill up. That's coming up very, very shortly. That's coming up next. It's going to be the 28th of February, Saturday at the Marriott Marquis downtown, right on the waterfront. How did that affect the net income? It dropped our net income, but remember, these are smaller indexes. So good questions, guys. Thanks to Connie Hill for helping out. Thanks to our great production staff, and thanks to all of you for being here with this class today. Appreciate you being here, and we will see you again next Wednesday. Take care, everybody. Bye-bye.